When an institution occupies a 4-block radius in the center of a major American city, the physical footprint alone dictates its financial reality. This is the Performing Arts Center of Los Angeles County. Most people know it simply as the Music Center. The institution carries massive artistic weight, serving as the official home for 4 renowned resident companies: Center Theater Group, the Los Angeles Master Chorale, the LA Opera, and the LA Phil. The public engagement is equally massive. Every year, nearly 750,000 guests attend over 540 ticketed performances across its venues. To see how an operation of this size is actually funded, we have to look at its primary financial disclosure, the 2024 IRS Form 990. The aesthetic of the campus suggests an art-centric nonprofit, sustained primarily by the creative output it produces for the public. The tax filing allows us to look past that aesthetic to see how the organization actually categorizes its labor and allocates its capital. By reading the financial architecture line by line, we can begin to bridge the gap between the public-facing cultural mission and the raw economic mechanics required to keep the lights on. We start our forensic investigation on the summary page. Here, the organization reported a total revenue of $69.8 million for the current tax year. Compare that to the total functional expenses required to run the operation, sitting at $77.5 million. This chart visualizes that gap. The organization is spending significantly more than it brings in, resulting in an annual operating deficit of $7.7 million. The breakdown reveals the primary funding sources. Line 9, Program Service Revenue, direct income from arts programs, represents $2.7 million. The majority of liquidity is on line 8. The Music Center relies on $54.9 million in philanthropic contributions and government grants. When viewed proportionally, the money provided by donors and taxpayers outweighs the money paid directly by the audience by a ratio of 20-1. Despite the annual operating loss, the institution is highly capitalized. Line 22 shows net assets totaling $98 million. These assets represent decades of accumulated institutional wealth and capital improvements to the campus. This results in an institution holding nearly $100 million in wealth while absorbing a $7.7 million loss on its day-to-day operations. The Part 1 summary illustrates an organization sustained by external support, not its primary creative output. To see exactly how that money is deployed, we turn to Part 3 of the 990, where the IRS requires nonprofits to categorize their expenses by specific programmatic accomplishments. The largest line item is $47 million, dedicated to a category labeled Center Operations. The narrative description below the number explains the mandate. The Music Center maintains and operates the facilities on behalf of Los Angeles County. Those facilities include the Walt Disney Concert Hall, the Dorothy Chandler Pavilion, the Amundsen Theater, and the Mark Taper Forum. That $47 million budget is consumed by the physical reality of these structures, basic maintenance, security, and the logistics of moving thousands of people. The mandate also extends past the walls of the theaters to include civic infrastructure like Gloria Molina Grand Park. It also covers the Jerry Moss Plaza, reflecting the geographic scale of the daily maintenance task across the downtown corridor. Compare that $47 million property operations budget against the second programmatic expense, TMC Arts. The organization spends $17.5 million on actual artistic programming. We also find another $2.6 million allocated to capital improvements, which includes leasehold transfers and debt service for the 2007 Mark Taper Forum renovation. The spending ratio, nearly 3-1 in favor of buildings over art, defines the Music Center's primary function as a property manager. Managing $138 million in total gross assets requires a specific administrative structure, which we find detailed in Part 7. The Music Center relies on a governing body of 49 independent voting members. A 49-member board maintains the vast network of influence necessary to sustain $55 million in annual fundraising. The executive compensation reflects the scale of the assets. President and CEO Rachel S. Moore receives a base compensation of $1.4 million, plus an additional $85,000 in estimated other compensation. Overseeing a multi-venue infrastructure complex with nearly $140 million in assets requires the same level of administrative oversight as a large for-profit corporation. Section B reveals how the physical labor of the operations mandate is executed. The Music Center outsourced $4.48 million for housekeeping. They also paid $1.3 million to Levy Restaurants for catering and concessions. The combination of corporate-level executive pay and multi-million-dollar outsourced labor contracts results in a financial complexity typically found in for-profit enterprises. Rejuvenating these facilities allow us to see where that $47 million operations budget is absorbed. Maintenance costs on structures this large persist continuously. An empty theater still requires climate control, utilities, and security. The architecture itself acts as a high-maintenance asset. The massive glass facade and specialized rigging systems of the Amundsen Theater represent ongoing structural liabilities. The Dorothy Chandler Pavilion serves as a legacy piece of infrastructure, requiring immense upkeep to preserve its historical footprint. These iconic structures demand millions of dollars in continuous preventative maintenance and guest service staffing just to remain open to the public. This creates a divide between the cost of the buildings and the cost of the resident companies performing inside them. While the Music Center maintains the stage, the performers themselves, like the LA Phil and the LA Opera, are separate financial entities with their own budgets and tax filings. The Music Center acts as the landlord, facilitating the venue for these residents. This explains the revenue gap. The $2.7 million in program service revenue covers only a fraction of the guest services provided for those 540 performances. At this massive scale, the architecture itself is the primary product being managed and preserved for the county. When we consolidate this data, we can see the final financial flow. Massive philanthropic inflows and investments move through a heavy corporate board, pushing $47 million into property operations and $17.5 million into arts programming. The evidence identifies the Music Center as a public-private real estate venture funded by philanthropy. Without the $55 million in donor support, the physical infrastructure of LA's art scene would be unsustainable. A tax return provides an assessment of an organization that cuts through marketing to show where the labor and the money are actually deployed. Understanding the mechanics of the Form 990 is essential for anyone analyzing the true operational health of the civic arts sector. The specific allocation of functional expenses reveals the operational reality of the organization more clearly than any marketing message.